Hello, Doug. Hi, everyone. We'll just give everybody another minute just to pop in before I start. Well, good afternoon, everyone. I'd like to welcome you to my webinar this afternoon. Hope everybody's enjoying their day so far. Today, I'm going to talk about how you can boost 2021 sales with qualified plans. And for those that do not know me, my name is Armando Testani. I'm the retirement services consultant at Security Mutual, and I work with Brandon Unger and others here at Algren. And this afternoon, I'm going to discuss how you can boost your sales with qualified plans. So let's get started. Let's take a look at the individual limits for 2021 and compare how little has changed from 2020. As you can see here, the 401k deferral is set at $19,500, with a catch-up deferral for individuals over age 50 of $6,500. So for participants over age 50, they can defer $26,000 into the plan this year. Now, unfortunately, this is the same amount as they were able to do in 2020, with the IRS not increasing many of their retirement plan limits for this year. With defined benefit plans, the limit is set at $230,000. This means when designing a defined benefit plan, we're trying to target the maximum allowable benefit received on an annual basis. This means that clients can get a benefit of $230,000 a year or $19,166 a month. This is also the same from 2020, For defined contribution plans such as 401k plans and profit sharing plans, the maximum allowable contribution is $58,000. Now, keep in mind that participants over the age of 50 actually have that catch-up deferral. So this will allow them to increase their total contribution from $58,000 to $64,500. And this is actually an increase of $1,000 from 2020. Now let's take a look at the compensation limit, which is set at $290,000. This means that for design purposes, the maximum salary we can use to design the plan is $290,000, regardless of what their actual income is. We're capped at $290,000. So if they make $1 million or $2 million, the most we can do when designing the plan, most salary we can use is $290,000. Now, this is an increase of $5,000 compared to last year in 2020. So that was a nice little increase to have as well. But it's also important to remember that when creating a plan design, it's really necessary to know the projected current year compensation in order to properly define if there are any non-owners that are considered highly compensated employees. Now, anyone who has more than a 5% stake in the company is considered a highly compensated employee. But if they have no ownership percentage and they made over $130,000 in last year's compensation, they're considered a highly compensated employee in 2021. So that's why it's always important to get the correct salaries. So if they have an employee who made over $130,000 in 2020, for 2021 design purposes, they're considered a highly compensated employee. And it's important to identify who is and who isn't highly compensated, because you can actually discriminate against highly compensated employees, whereas rank and file employees, the IRS frowns on any sort of discrimination against them. Now, I know that this is a lot of information regarding the limits, so I'm glad to mention that we actually offer a downloadable flyer that you can see the picture here on the right. You can download this from SML Plans, which is a website we have dedicated to qualified plans, or you can reach out to myself at Security Mutual or Brandon Unger at Algren as well, and we'll be more than happy to send you any information that we have regarding qualified plans. So let's move on and take a look at identifying clients and how you can help boost their contributions and make that extra sale. So before we get into the nitty-gritty, let's talk about targeting clients. Sometimes the best way to find new clients is to work with ones you already have. More often than not, existing clients that are business owners have some sort of plan already in place, whether it's an existing SEP IRA, an individual IRA, a 401k or profit sharing plan. There's already something there to work with. Now, many times a client is looking to increase their contributions to their existing plan, but don't know how to go about it or who to talk to. And this is where you come in. Using your familiarity with your client, you can offer them solutions that will best fit their needs. Often you're faced with a business owner that's looking for some tax relief, and what better way to get them tax savings than offering a qualified plan? And what's great about retirement planning is what's good for the existing client can be applied to new clients as well. There's services such as Judy Diamond, and they offer a way to see businesses in your area, what they have for retirement plans, and the service will give the names of the plan and trustee information as well. And this can be used to target new clients, clients that already have something in place, but might be looking for something more. So let's take a look at what we can offer these new and existing clients. There are two types of qualified plans that we work with here at Security Mutual. There's defined contribution plans and defined benefit plans. We can design various plans in the defined contribution market and DB market. So let's take a look at the different types of plans we offer. Here we have defined contribution plans. Some of the defined contribution plans we can design for your clients are traditional 401k plans, or some call them plain vanilla 401k. Then we have safe harbor 401k plans, which can be more beneficial to owners, especially when you have a number of employees in the plan. We also offer what we call the MicroK, or an owner-only 401k plan. It's cheaper to administer than a regular 401k plan, has cheaper annual fees, and there's not a lot of complex testing like you get in when you have a 401k or profit-sharing plan when you have a number of employees. Then you also have what the more advanced plans, like the Double Advantage Safe Harbor plan, or a DASH plan, as we like to refer to them. This blends a safe harbor plan with a profit-sharing plan. And speaking of profit-sharing plans, we also offer age-weighted plans, new comp plans, integrated profit-sharing plans, as well as your standard profit-sharing plans, where everyone gets the same percentage of contribution. So let's take a look at some of these plans in action. Cursory planning for the last 20 years or so for very small businesses is to use a SEP IRA as its retirement plan. Businesses that have more than a handful of employees may also consider a basic 401k to recruit and reward employees. We believe that the best way to reach small businesses is through actual next level planning. These plans are designed to offer competitive benefits for the employees, but at the same time attempt to allocate the vast majority of the contributions and benefits towards the owner, the small business owner. These new breed of plans, they replace the simple and the set plans. We like to call them, things like the MicroK, the Dash 401k, 412E3, and traditional 430D, traditional defined benefit plans. And this also includes cash balance plans. These are markets that we're very familiar in, and we've actually been around in these markets for a while now. I'd say well over 40 years we've been administering these type of plans. Now, let's take a look at a comparison between a traditional SEP IRA and a MicroK. Let's look at the difference between the two plan designs, with one allowing an increase in contributions. On the left here, you have a SEP IRA. It's a plan that's been around for a long time. It's quite common, and it's pretty limited. Contributions are anywhere from 0 to 25% of pay. And there's also a 3-year wait that can be put on top of it, and no loans can be taken from the plan. One big thing as well is no life insurance can be purchased in a SEP IRA either. Whereas with qualified plans, as long as the plan document allows for it, life insurance is a permitted investment. The MicroK, an owner-only 401k plan, cheaper to administer than other types of 401k plans, because they're limited to owners and their spouses and partners. So as long as you just have owners with their spouses, it could be 1 owner, 2 owners, 3 owners, they can do a MicroK plan. But whenever you have rank and file employees entering the plan, then you're going to go to a more traditional 401k plan or something similar. But the MicroK is a very powerful owner-only 401k plan, and also very popular with a lot of our agents that sell qualified plans. Now, both the SEP IRA and MicroK plan, you can put 0 to 25% of pay away. But the MicroK, you're allowed to actually have those salary deferrals, including those catch-up deferrals for people who are over the age of 50. There's a 1-year wait in these MicroK plans, but you are allowed to take plan loans as well. And best of all, especially for life insurance agents, you can sell life insurance in a MicroK, whereas in a SEP plan, you can't. So let's take a look at how these plans would look in action. Here we have an individual making $100,000 a year, maxing out his SEP IRA plan 25%, so his maximum contributions, $25,000. On the MicroK side here, we have that $25,000 employer contribution, and as an employee, he can defer his own money into the plan as well. And because he's over age 50, he can put the maximum $26,000 into the plan. So the total in a MicroK for an individual making $100,000 is actually $51,000 compared to $25,000 in the SEP IRA. And best of all, if your client's looking to purchase some life insurance, what better way than do that than put it in the MicroK, where the contribution will help pay the life premiums in the MicroK plan. And it's especially great when you have a client who is rated. What better way than to buy life insurance for somebody who's rated than have Uncle Sam subsidize that life insurance? Now, what happens when you have a client with eligible employees? Let's take a look at it. 401k plans must satisfy discrimination testing rules. The rate of salary deferrals of the owner and family members will be dictated by what we call the actual deferral percentage, or the ADP test. This is dictated, the ADP test, by the rate of the rank and file employees. So if you have rank and file employees who defer 0 into the plan, the owner defers 0 into the plan. And if you have the employees on average defer 3% of pay into the plan, the owners can only defer 5% of pay into the plan if eligible. So when dealing with 401k plans, the ADP test is often problematic for small businesses, but there are solutions to that. And that is the 401k Safe Harbor plan. Fortunately, Congress recognized this problem, and since 1997, a small business owner can elect to provide the Safe Harbor contribution, which is usually just a flat 3% with immediate vesting to all eligible employees. The use of this Safe Harbor actually eliminates that ADP testing that we were just looking at in the other slide, and it allows all owners and their family members to defer the maximum without any discrimination testing. Now, there's 2 ways to eliminate the ADP test using these Safe Harbor provisions. The first is what we call the non-elective. It's just a straight 3% of pay to all eligible employees, and thus allows anybody else to defer the maximum, and you don't have to worry about satisfying ADP testing. Then on the other end, you have what we call the matching Safe Harbor. This provides a matching contribution at least as favorable as the 3% of pay, also with immediate vesting. You do this and the ADP testing is eliminated, allowing each owner and family member to defer the maximum regardless of the actual employee rate of participation. Now, what if they want to add more into the plan? Well, this is what we have, what we call the Dash 401k plan, or Double Advantage Safe Harbor 401k plan. This plan works very, very well with a Safe Harbor 401k that awards all eligible employees a 3% of pay. And then on top of that, we can actually layer a profit sharing plan to help boost contributions even more. So let's take a look at this in action. Here we have a law firm. You've got 11 participants in the plan, 2 owners. You have a highly compensated employee because they make over that. They made that $130,000 last year. So this year they're considered a highly compensated employee. And then you have 8 other employees ranging from 22 to 50, salaries all the way from 27,000 to 65,000. Now, here's an existing safe harbor for the client. They're just giving everybody a straight 3% of pay, and the owners are deferring the maximum contribution, and their highly compensated employee is also deferring $4,000 into the plan. Now, they like this, but they're only deferring, contributing $34,700 for each owner into the plan, but they would like to do a little bit more. So this is what we're going to do. We're going to add an actual profit sharing plan to the existing safe harbor plan. So you're already targeting somebody who already has an existing plan, and you're just adding another benefit on top of that. You're adding another layer. So if we look here, we give a 2% profit sharing contribution to the rank and file employees. The highly compensated employee gets a 3% because they want to give them a little bit more because they've been with them for a while and they look at them as being an employee they want to keep. And the owners are getting just over 10%. So here we have the owners actually maxing out at $64,500. The highly compensated employee goes from $7,900 before, but it was actually $3,900 for the owners. That's how much the owners put in because he deferred $4,000 of his own money into it. So now the owners are putting in $7,800 on his behalf, but with his deferral, he goes to $11,800. And now look at these employees. We don't even double the employees' contributions. They go from 3% to 5%, but the owners are going from 3% to just over 13%. So they're contributing $155,000 into this plan, and they're getting 85% of the pie. So 85 cents of every dollar going into the plan goes to the owners. This is a very common type of plan that we work with. A lot of owners like this because it gives them the flexibility. They don't have to put that profit sharing contribution in if they don't want to. Every year they could look at how profits were at the end of the year and say, okay, we had a good year, we'll put it in. If we didn't, we don't have to. We'll just give that 3% to everybody, but we can still defer that maximum $26,000 in on our behalf. So this is a great plan. And if they ever want to purchase life insurance or offer that to their employees, that's something that they can do as well. Any qualified plan, as long as the plan document allows for it, is allowed to have life insurance in the plan. Now, they can come back and say, you know what, we like putting in $64,500, but we want to put away more. Can we do more? Absolutely. This is where a defined benefit plan or a cash balance plan will come into play. So let's take a look at some of the defined benefit plans we offer, from traditional DB to the 412(e)(3) plans, as well as cash balance plans. No plan is too big or too small for us to work on. I've worked with Brendan on many cases. He's come to me with clients or agents and say, hey, listen, I've got a small case, I've got a big case. They want to put away a little or a lot. No plan is too big or too small. We'll be more than happy to design any sort of plan. We work with Brandon all the time. You can either reach out to myself or reach out to Brandon if you're more comfortable with that. Send him the information. He'll be more than happy to send it on to me as well. But like I said, no plan is too big or too small for us to work on. Now, like the previous defined contribution slide, as you can see, we do have a lot of educational material that is available to download regarding defined benefit plans as well. And again, all of our materials are available online, or you can contact myself or Brandon as well. And best of all, a lot of our materials, the great majority of what you see here as well, is also client approved. So not only will it educate you on what we offer, but it can educate your client as well. And it's a great little tool to send them and say, hey, listen, I have an idea I would like to discuss with you, but beforehand, I'm going to email you something, take a look at it. Well, then you'll share your thoughts with me and we'll discuss it. And maybe this might be a plan that works best for you. So like I said, all of our materials are agent approved and 99% of them are client approved as well. And we've got stuff from beginner to expert level as well. You know, we're here to support everybody. So let's take a look at a defined benefit plan. Here we have a law firm. We've got 2 owners, high net worth. Now keep in mind, we can't use their entire salary since the plan limits we discussed earlier do limit the amount of salary that we can use to the design to $290,000 for a year. Their owners' objectives are pretty clear cut. They want a safer retirement while receiving a tax deduction as well. And they're also looking to maximize any amount of life insurance allowed within the plan. Now let's take a look. Here's our initial plan design for these 2 participants, Nelson and Murdoch. As you can see, the owners are maximizing their contributions within the plan. They're also receiving a $3 million death benefit, each of them. So we've essentially met their objectives. They're getting a large contribution and they're getting a maximum amount of life insurance. And if you see the breakdown here, they're getting a total of $371,000, just over $371,000, with the 55-year-old getting a contribution of $225,000 and the 50-year-old of just over $145,000. But they're also still getting that same $3 million death benefit. We've maxed out their lump sum benefit at retirement of just over $2 million. But look at the contribution. We've decided to show this with an annuity and life insurance in the plan. And look at the life insurance premiums, $161,000 for both of them getting a $3 million death benefit. Keep in mind, this is fully tax deductible. A 412(b)(3) plan is a type of defined benefit plan. They can write this off at the end of each year to help minimize any tax liabilities they may have. So let's take a look at the life insurance a little bit more in depth as well. As I mentioned, we have a 55-year-old and a 50-year-old, both getting $3 million. Here are the cash values at retirement of just over $635,000 and $843,000. And you'll see this column here, the PS58 costs. Now, PS58 costs must be paid at the end of each year. It's a form of a tax on the cost. Now, the reason people pay this in qualified plans is by paying the PS58 costs, that death benefit, less any cash value accumulated, is non-taxable. So if anything happens to that person while they're in the plan, if they pass away, the death benefit less the cash value is non-taxable. So that is an added benefit as well. And again, this is the premium, $161,000. And for our illustrative purposes, we're using Security Mutual's Whole Life for You unisex product, a whole life product specifically designed for qualified plans. And speaking of life insurance and qualified plans, safe to say we run the gamut when it comes to qualified plans. We can do defined contribution plans, defined benefit plans, any type. But as an insurance company, we're also heavily invested in the use of life insurance and qualified plans. So let's talk just a little bit about life insurance and qualified plans. Life insurance is a permitted investment in all qualified plans. And in order to place the survivor benefits into a plan, it's important to remember that the plan document must allow for the use of life insurance within the plan. And once that's been satisfied, the client, upon consultation with you and any other advisor, can then decide whether or not to add whole life or universal life to the policy. It's important to remember that life insurance in a qualified plan must be unisex as well. So you have to use unisex products. And I'm happy to say that Security Mutual does offer unisex products for whole life and UL. And we also have a wholly owned subsidiary called SAI, Security Administrators. They're an administrative firm, fee for service only. They do not do any commission splitting at all. And they've been in the business for over 40 years. And I'm pleased to say that all of their plan documents allow for the use of life insurance within the plan. It's as easy as just checking off a box within the plan document. They're very familiar with working life insurance in qualified plans as well, because I do know that there are a number of administrative firms out there that don't. Now, placing life insurance in a defined benefit plan has to ensure that all participants are covered. We can't pick and choose who to cover. That violates some testing rules. Whole life and UL are both acceptable to the plan, depending on the plan type. For instance, 412(b)(3) plans require the use of whole life insurance only. They don't allow the use of UL. That's set by the IRS. That's not us. But traditional defined benefit plans and cash balance plans do allow for the use of whole life or UL in the plan. And a benefit of adding life insurance in a defined benefit plan is that it actually increases the plan's contributions so that somebody can get an even higher deduction when adding life insurance to the plan, unlike a defined contribution plan where the life premiums are actually part of the plan's contributions. Now, placing life insurance in a 401k profit sharing plan gives flexibility on who is covered. In some cases, you can have only the owners who are eligible for participation for the life insurance. Whole life and universal life are both acceptable, and clients can even use what we call as age money to buy life insurance. Now, what's age money? Well, it's money from an existing IRA or another type of defined contribution plan that's accumulated over the years. They can actually roll this money into their new or upgraded 401k or profit sharing plan, and they can buy life insurance in this plan above the incidental death benefit limits. And you might be saying, well, what are those incidental death benefit limits? Well, incidental death benefit limits are when the life insurance inside a retirement plan must be incidental to the purpose of the plan. These rules could be very familiar to a number of you, but if not, let's just review them quickly. Now, less than 25% of a plan's contributions may be purchased, used to purchase universal life insurance or term blends in a defined contribution plan. And for whole life, we can use up to 50% of the plan's contributions towards the whole life premium. Note that these rules apply to the plan's contributions and not the plan's account balance. Now, in defined benefit plans, we also have these same rules. If you would like to use the 25% for UL or up to 50% for whole life, you can under what we call the 74-307 method. There is another method called the 100 times rule. And the 100 times rule simply states we're going to take 100 times the monthly benefit, and that's the maximum face amount that we can use towards life insurance. Now, to be honest, it's not very common that people go with the 100 times rule. I would say 99% of the times we're using that 74-307 method, which duplicates this defined contribution plan, up to 25% towards UL and up to 50% for whole life insurance. Now, what are some reasons to include life insurance in a qualified plan? Well, there's a few standout reasons. Perhaps the biggest reason is that the life insurance premium in the plan is tax deductible, even when the participant receives a substandard rating. So if you have a client that's considered Table 3 or Table 5 or even higher, what better way to purchase life insurance than have Uncle Sam subsidize it? And compared with buying life insurance outside of a plan, you can get more coverage in the plan from the same out-of-pocket expense or the same coverage for less. Adding life insurance to a qualified plan also saves the employee the personal premium expense, especially in a defined benefit plan, because the owner is making the contribution on their behalf, and they can get life insurance coverage using that plan contribution. So it's essentially free coverage for the employee. And another benefit is that the death benefit paid from the plan is estate tax exempt if it's paid to the spouse using the unlimited marital deduction. The same death benefit is also income tax free, less the cash value. This is why they pay that PS58 cost I was talking about a little while ago. And for business owners, an added benefit is that the life insurance is generally protected from creditors. Here at Security Mutual, we do offer 2 life products. As I mentioned earlier, our Whole Life for You Unisex is our whole life product, and our Flex UL Unisex is our Unisex UL product. And there are actually exit strategies. Now, if your client does put life insurance in the plan, there's 5 possible outcomes with what happens to the plan, the life insurance afterwards. So the first is the participant may die while the policy is in the plan. While this is not ideal solution for the participant, it does happen in plans. And in this instance, the death benefit is distributed to the beneficiary. The second outcome is that the policy may be surrendered by the plan trustee. They just surrender the policy. The cash value that's accumulated then goes into the plan account, and the participant no longer has any coverage. The third outcome is a policy that can be distributed to the insured participant. Fourth policy is that the policy may be sold to the participant as well. This occurs when the participant purchased the policy for the accumulated cash value. It's not very common because it often requires a large amount to purchase that policy outside of the plan. But the last outcome is rather unique to Security Mutual. I know of one other company that offers something similar, but not on the same level. This is our net amount at risk exchange rider, or some like to call it the attained aged exchange rider. So let's take a look real quick at what it does. The best way to describe this is just using an example. Let's say you have a client who has purchased a $2 million death benefit. Over the years, he's accumulated $400,000 of cash value. And when he retires or leaves the plan, using our rider, they have the option to purchase a new policy outside of the plan for the maximum face amount of $1.6 million, because it takes the old death benefit less the cash value. That's the maximum face amount. It could be whatever type of policy he wants. It doesn't have to be the same, and it won't be a unisex policy anymore. It will be a sex distinct policy. The new policy actually has premiums paid at the participant's attained age, but what we do is we issue it at the level it was issued at when they took out the original policy. So if they were age 50 and a preferred non-smoker, we'll issue it as a preferred non-smoker or a comparable class. Even if they've developed diabetes or had a heart attack over the years, we're essentially issuing a new policy with no underwriting. And best of all, it's a fully commissionable sale for you as the agent as well, because it's a brand new policy. Now, we do have a flyer on this. I know it's a lot of information and we're running short on time here, but we do have a flyer that is available on smlplans.com. That's our website. Or you can reach out to me or Brandon as well. If you're interested in doing a design study, complete one of our fact finders. They can be downloaded from SML Plans, or reach out to myself again or Brandon. You can email us here at, as you see the emails here. Just get a design study to us. What we need to know are just the basics: who's there, what do they have now, what's their budget, what are they looking for. That'll help determine what type of plan to design for them, and do they want life insurance as well? Because as I said before, in defined benefit plans, that's going to actually increase the plan's contributions. Now, we do have a lot of resources that are available. As I have been mentioning, these are both to help educate you and to help educate your client as well. If you're interested in them, please go to smlplans.com. You can download them from there, or just reach out to myself or Brandon Unger as well, and we'll be more than happy to help you in any way we can when it comes to qualified plans. We're here to help you make that sale. So having said that, I know we're at 2:30 right now, so it's the end of the session. I just want to thank you. I hope you've learned something, and I hope this was beneficial for you and we can do some business in the future together. Thanks, everybody.